Welcome to the Stockout. This is your show at FreightWaves about all things related to the CPG industry. Those are the consumer packaged goods, which have actually outperformed the stock market by quite a lot this year by falling less than the overall stock market. So today on the Stockout, I'm going to be talking about Smucker's results from last week, which I think reveal what some of the other CPG companies are going to talk about when they talk about their second quarter, results. Talk about some of the BLS data, the Bureau of Labor Statistics data on inflation, and some on commodity prices, and also run through some data on ocean and rail. And I think the theme for today's show is not seeing any easing in inflation in food prices. So we're going to talk about those things today. I'm your host, Mike Baudendistel. Follow the CPG industry here at FreightWaves, in addition to following the rail and intermodal industries very closely, work with customers on their rail and intermodal data needs. So if any of those things are needed for you, feel free to reach out at mbaudendistel@freightwaves.com. What we have up on the screen now is this is a real easy way to get a hold of me and follow my writing at FreightWaves. Is just go on up to newsletters, go to freightwaves.com, go on up to newsletters, and right there at the first one under supply chains is the Stockout. So try to get out 2 newsletters every week, unless there's so much data stuff going on that it's only one. So with that as a quick intro, I'll get into the content here. And really, topic number one is the J.M. Smucker company last week reported earnings. Stock was actually pretty strong for the week, up about 3.5% in the last 5 trading days, and only down about 6.5% for the year, which is a lot better than the market as a whole. It seems like there's been a big flight to quality in the stock market, a flight to companies that are less cyclical, that are more defensive, that are big cash generators and pay a nice dividend. I think the Smucker company meets all of those descriptions. And I'll go through the results just real quickly and then talk about what this means for the other CPG companies. So a little overview of the results. Net sales, increased 6%, sort of when you exclude divestitures, increased 5% for the year. Adjusted earnings per share increased 18% for the quarter, up 3% for the full year. Still experiencing a lot of margin pressure. So for the quarter, the gross margin declined 570 basis points. It was a little bit of a sloppy quarter with the Jif recall, which really had more of an impact after the quarter, and I'll talk a little bit about that. But when we look at fiscal 2023 for Smucker, which began May 1st, they revealed some interesting things, sort of as far as their expectations go for this upcoming, let's call it next 12 months, starting a month ago in May. So company expects prices to increase 15% on average across the board in the company's products, and so that's a little bit worse than what we've seen for other CPG companies and just food at home inflation in general. This latest data from the BLS said 11.9% increase in May in terms of food at home prices, basically grocery prices. And interesting that 15% that Smucker is expecting for next year, kind of right in line with coffee prices for grocery, up 15%. That's going to be their Smucker's biggest ingredient, ownership of the Folgers brand and Dunkin' for at home consumption. So what justifies a 15% increase in prices that Smucker's planning to get through the next year? Their costs are rising, mid to high teens, and so basically they're trying to get back all of the dollars of cost pressure with price increases, and those typical CPG culprits for price increases are present here, where it's ingredients, which are now almost half of their cost structure in terms of cost of products sold, labor, packaging, freight, and manufacturing costs, which includes some outsourced manufacturing costs. All of those things are still rising for Smucker and for CPG company at whole. So they really haven't gotten much relief, if any, on their costs. And so, with the price increases sort of making it dollar for dollar, the margin pressure is only expected to be 30 basis points in the upcoming fiscal year, which would be quite a lot better than what the company experienced in its fiscal 2022, where for the full year, gross margin contracted 540 basis points, which really wasn't too dissimilar from the other CPG companies sort of throughout the last 12 to 18 months. Costs rose faster in the CPG industry, faster than those companies could pass those costs on, through the retail channels and ultimately on to consumers. So really, from a consumer perspective, there's another shoe to drop or two, or maybe even more than that in terms of higher, grocery prices. As far as this means for the retailers, I read through an analyst report that really brought up a good point about the retailers and sort of the CPG companies' relationship with the retailers is really sort of the perspective of a lot of CPG management teams is that retailers are going to be receptive to increased prices that they have to pay to CPG companies and the prices that go on store shelves, so long as there's still pressure on the commodity prices. And so the retailers are basically auditing the price increases that they're receiving from the CPG companies more closely, pushing back on those further. And a lot of CPG companies expect that once those inflationary prices ease, that the retailers are going to say no more price increases from the CPG companies, and that's going to sort of be it. And the CPG companies won't have a lot of more opportunity to push price increases through the retail channel. And so, as a result of that, the CPG companies right now trying to get the price increases sort of in place and get them in place quickly, so they aren't sort of the segment that's holding the bag if commodities start going the other way. CPGs are still trying to make up for a lot of the cost pressure that has taken place over the last year and a half. It does take time for those price increases to get into the retailers and onto the consumers, and so they want someone else to sort of bear those costs. They don't want it to all be the CPG industry. So it's trying not to be the victim of timing, and so the CPG companies trying to pass through price increases as quickly as possible. The other thing that comes up as of the Smucker's results, I think, is a big question, is the elasticity. So that 15% price increase across the board for the Smucker company. The question is, how are consumers going to respond to that? What the company is modeling is that there's going to be a 7% impact to volume and mix as a result of those higher prices. So, certainly there's going to be some elasticity. The CPGs and Smucker have said, really there hasn't been a lot of elasticity so far, at least either no more than they've seen historically or less than they've seen historically. It'll be interesting to see if that holds up in the next year when the pressure on consumers really intensifies. I mean, those comments the other week from Jamie Dimon, the JP Morgan's CEO, that the consumer has another 6 to 9 months of sort of spending power left before they really have to retrench. I mean, I think that could have a huge impact on CPG. So we'll see what happens there. There does seem to be evidence already of consumers, buying more private label brands, shopping at places like Aldi, buying more groceries at Walmart, which actually that might not hurt a company like Smucker, that huge retail partner with Walmart. Large part of their sales. So the elasticity is sort of the big question here. It seems like so far the CPGs that have increased their prices, let's say 4 or 5%, maybe 6%, really have not seen a degradation in volume, but those who have taken prices up 8, 9, 10%, have seen some decline in volume. Now, it's been low single digits, but you have seen some changes in consumer behavior there. As we get up into 15%, you would think that consumers would change their behavior a little bit more. It's pretty noticeable when, let's say, a box of Uncrustables goes from $9.99 to $11.50, and the parent that's buying that is buying multiple boxes. Pretty noticeable. So we'll see on that. Company also talked about the Jif recall. I was one of the unfortunate people, at least I think my family thinks, that got sick because of the Jif salmonella situation. Was badly sick for about 24 hours, and then it sort of evaporated into the rearview mirror. And at the time I was thinking I would never eat Jif again, but now I'm sort of thinking, well, things happen and probably will blow over at some point. And Smucker's outlook for the next fiscal year sort of was along those lines, where I think it's going to be a 2% hit to sales, a 90% hit to earnings. That's mostly because they have unsaleable inventory and manufacturing downtime. and don't think that it's going to be a situation where the brand is really damaged by that situation. So I'll move on to the next topic here. Overall, I thought that the Smucker's results were interesting. Shows that food prices are really going to be high, and maybe going forward, the consumer is even going to be more stretched for discretionary items once they get past the grocery prices and energy prices. So topic number 2 here is the BLS, Bureau of Labor Statistics, shows a steep increase in food at home prices. So if you're hoping for lower grocery prices, which I think we all are, didn't see any evidence of this in this latest data, which goes through May. Now that is on, let's call it a 6-week lag of when these prices actually took place. But some of these statistics are pretty nasty. Food at home prices in May up 11.9% year over year from last May. That's more severe than the 8.6% overall rate of inflation, and the highest at-home food price inflation since April of 1979. So Biden is looking more and more like Jimmy Carter all the time. Prices increased 1.4% from April alone, just in 1 month. And that was the 5th consecutive month of a 1% or greater month over month increase in grocery prices. So it's pretty bad out there. So 5 out of the 6 major categories increased more than 10%. The only one that didn't was fruits and vegetables, which only increased 8.2%. So maybe there's never been a better time to be a vegetarian. Eat your vegetables. So no evidence of food prices subsiding, really at all. And maybe if there's good news in this for CPG companies, is that the inflation rate at restaurants is still is very high also. Now that was a 7.4% increase, but still maybe on a dollar basis, it's CPG is not looking any less attractive versus going out. And I do think people will eat more at home as just one way to mitigate the fact that everything is rising in prices. A few items I'll call out in that report: eggs up 32 price of eggs up 32% year over year, which has been impacted by the avian flu. Butter and margarine up 20.2%. Chicken up 17%. Milk up 16%. Coffee up 15%. Pretty bad out there for the average consumer, and we're really going to test the theory that the U.S. consumer is always resilient. We'll see. Topic number 3 is also related to rising food prices, which is soybean prices are hitting a new high. I have a graphic in there from our partners at Bar Chart Inc. And so the way to read this is soybean prices now trading at $17.70 a bushel on the Chicago Board of Trade, where they trade the commodities. This is the 3rd largest grain commodity that's moved by rail, after corn or wheat. It's still very important. And basically, this is now higher than prices of soybeans, now higher than they were in 2012, which was impact of the U.S. drought. But this year, soybean prices are being hit by basically the war in Ukraine. They export a lot of cooking oils, from the sunflower seed oil. Those compete with other types of vegetable oil, including soybean oil, including palm oil. Some of the countries around the world have gotten to be more protectionist out of their vegetable oils, not allowing as many exports, which is exacerbating the situation. The energy prices are increasing the price of fertilizer, which go into the crop prices, and then the crop prices are making the price for animal feed more expensive. That's hitting the price of meat, and so you have the price of meat well up into the double digits. I mean, even last year, I think the price of a lot of different meat commodities were up 20-30%. So those type of pressures continue, and it's just just one more factor making it more difficult to eat in a cost-effective manner. And so just in short, from those 3 news items, not seeing any evidence of food prices coming down anytime soon, not with commodities hitting new highs for some of these food-related commodities. Topic number 4: inventory levels are highly elevated for non-food items, and I do draw this distinction between food items and, let's say, consumable products, so the CPG type products and everything else. So you have a graphic here that was from this was from an article that Rachel Premack wrote, talking about, you can look at it on the site, it's a really good article about Target. She's talking about, why is everyone freaking out over Target's inventories? Well, you see there, kind of in the middle of that screen, Target inventory up 43%, sales up only 4%. They made a big move to cancel orders, make a strong move to sell inventory they don't want. Walmart's are very high as well. They do, Walmart does say, well, some of that we wish we didn't have. Some of it we're kind of glad we have, because it's been hard to get products shipped and in stores. When you look at some of the others, every one of those on that list, if you can see the screen, inventory levels are higher than the sales growth, with the exception of Walgreens, which is maybe where you would want to have excess inventory. That might be related to not having enough baby formula, not having enough prescription drugs, not having enough consumables. So that's where you actually wouldn't mind having a little bit more inventory. So kind of in short, it's a situation where the things that are in high inventory are the things that people don't really need. I mean, listen to the results from Walmart, and basically the people are spending just as much money on a trip to Walmart. It's just once they buy the gasoline, maybe, and they buy the food, there's just not as much left over for what they call general merchandise, which are things like toys, patio furniture, et cetera. So it's really, these retailers are being left with the wrong inventory, and we've sort of gone from having too little of everything to having too much of everything, maybe with the big caveat that food items are still in low demand. And that sort of gets to the debate of, is the fact that these inventories are so high at so many retailers really going to have an alleviating effect on inflation, because there's going to be lots of discounting? And my perspective is no, because those are all things that people don't really want, don't really need. And what would really make a difference would be lower food and energy prices, and we don't see any evidence of those falling. See evidence of those rising. I'll move on here. Topic number 5: FreightWaves ocean data shows import volumes falling off a cliff. So this was a really great article, got a lot of attention last week, written by my colleague Henry Byers, who is our ocean guru, one of our ocean gurus, data analyst and author of some of these articles. And he doesn't write a lot of articles, but when he does write the articles, you really need to read them. And this is an example of that too. So Henry writes an article with data that he sourced and built the apps for in Sonar, and have a chart that shows the inland ocean TEU volume basically falling 36% since May 24th. And if we can bring up this chart here, what I like about this chart is it goes back to sort of pre-pandemic levels. Back, look at the left side of that chart in 2019, and that's sort of kind of your baseline volume. Sort of not a great year for freight, but kind of in a normal situation before the work from home and all of that. You've seen the spikes in 2020 after the lull of COVID shutdown, and really they had been elevated ever since. A lot of that on the right side, those elevated import volumes really went towards building inventory levels, and all of a sudden everyone sort of woke up and realized we have too much inventory for general merchandise, and now the imports are falling off a cliff. And what a lot of people had expected was that data was related to the shutdowns in Shanghai. And as soon as the shutdowns lift, then there's going to be a huge surge in imported volume, and those numbers will go just right back to up to where they were, maybe even beyond where they were. But what Henry's data shows, and I encourage you to go back and read the article, is that a lot of that imported volume wasn't just delayed. And it wasn't really delayed. It was moved out of a nearby port. And so it just came into the U.S. through a different channel. And so it's not a situation where there's a huge amount of pent-up demand for ocean imports. It's just that there's less volume coming in, because ultimately there's less demand with those high inventory levels. And would expect to see this starting in sort of the first 2 weeks of July, given that the ocean times tend to be, let's say, 30 to 45 days from when those orders get booked and put on the container ship to where they actually get imported in the U.S. Varies depending on which coast you're coming through. If you're coming through the Panama Canal, it could be full 4-5 weeks. So I think that speaks to our view that the demand for truckload volumes and ultimately intermodal volumes, which really have not cracked yet, at least on the domestic side, that those are likely to head lower, in the coming weeks. Henry also talks about some of the macroeconomic indicators that he's watching in his article, which some of those include the revolving credit back up to pre-pandemic levels, so people spending more on their credit card, not necessarily changing behavior quite yet, but maybe having a little bit higher balance on their credit card. Of course, that's the revolving credit. The non-revolving credit, those are at high levels too, because a lot of people bought homes at very elevated prices. Now we're starting to see the home building industry start to roll over. There's still plenty of homes that are halfway finished, including a lot of multifamily that still have to be completed, and inventory levels of homes are still at a low level. But in terms of new home starts and the volume of homes that are being traded, those have already come down with the sharp, let's say, call it 2.5%, almost 3% increase in mortgage rates. It's a big deal for mortgage rates to go from 3% to, let's say, 5.5%, closer to 6%. Also, the savings rate down to 4%, the lowest since the Great Recession. So there's plenty of evidence to suggest that consumer is under pressure, and not a lot to the contrary, other than the fact that there's still a lot of job openings. There's still a lot of companies looking to hire, but that does tend to be a lagging indicator. And so it is a concern if most of the economic indicators are pointing to a slowing economy, maybe a recession, and the only thing that's really positive is a backwards-looking indicator. Topic number 6, I'll close out the show today with a topic that followed for a long time. Railroads and rail traffic. The rail traffic is down in most carload categories. Have a graphic on that on the surface, on surface this looks kind of mixed. But if you look at this on a year-over-year basis, it's almost a red chart. But bring your attention to this. This is the month-over-month change, and the pattern here is that those commodities that are moving in rail carloads that have much higher prices than they used to, those are up, in the last month. So coal benefiting from the higher energy prices, grain from the very high agriculture prices, petroleum products, of course, and then some primary metal products. But some of these other things are a little bit more cyclical in nature. Chemicals carloads. You think of chemicals as going into a lot of consumer durables, consumer non-durables that go into a lot of autos. So there's certainly things in there. A lot of building materials. Those are starting to fall. Motor vehicles. Those are down 13. Motor vehicle shipments, which are primarily finished vehicles, those are down 13% in the last week. So it does seem like overall, the economy is slowing for the rail carload volume, and that's one that I encourage you to look at in addition to the intermodal data that we have in Sonar on a very granular basis. In fact, one tidbit is that Warren Buffett would talk about rail traffic as being his favorite economic indicator. Part of the reason for that is that it comes out every week, and because it just touches so many different sectors of the economy. So when you see that, and most segments are down, year over year, kind of the only ones that are up recently are those driven by higher, prices of, let's say, energy and agriculture products, which probably on balance have a negative impact because of what it's doing to the consumer. Still just one more piece of evidence that the consumer is going to be under a lot of pressure for the foreseeable future. So with that, hopefully this wasn't too much of a doom and gloom type presentation, but it's kind of calling it like I see it right now. And I would encourage those who are not signed up already to please go to www.freightwaves.com/the Stockout, sign up for my newsletter, sign up for some of the others that would I think pertain to our audience here that is either in the CPG industry or is a broker or carrier or supplier that's in the CPG industry. The retail one is a really good one. Also, running on ice, the cold chain. There's a lot of overlap between those industries and the CPG industry. One of the interesting things from Sonar that one of my colleagues, Donnie Gilbert, was describing the other day on FreightWaves Now is that the tender rejection rate for reefer has actually fallen below dry van for the first time. And that doesn't usually happen because reefer is a more concentrated industry. It's not as competitive. So, I think if you're a reefer shipper, you should be able to have your loads covered much easier than you have in recent months. Those reefer tender rejection rates were high. So with that, hope everyone has a great week. And that's all I wanted to cover today. Thank you.